And today we're looking at the stunning collapse of WeWork. We knew the bankruptcy was coming. We keep getting headline after headline as to how they're going to navigate their office leases as they go through bankruptcy. Bloomberg's Sonali Basak joins us now. We're looking at WeWork immediately dumping 40 New York City office leases.
And remember, 40, you can put that into context here because it is one of the biggest areas for WeWork, but they have more than 700, really more than 750 leases when you look at the totality here. So a lot of pain to be seen, even above and beyond. Remember, the bankruptcy allows them to start exiting these leases more quickly than they would have before. Remember, it was just a matter of months ago that they said they would enter this process of negotiating leases, again, exiting leases. Clearly, that has been difficult. Clearly, those negotiations with landlords have been difficult. So now this bankruptcy process really sets off a wave when you think about how to think about commercial real estate moving forward and the total exposure that WeWork really has. Remember, this is a bankruptcy with $19 billion in liabilities.
Yeah,
so just in terms of the leases and what the bondholders are also owed at the end of the day is a lot of money.
Sonali, you make a really interesting point there. You talk about the fact that the property holders have been pushing back quite strongly, and ultimately that has resulted in the Chapter 11 filing. What does the fact that they have done that tell us about what is going on within the office market, and tell us about the effect that this Chapter 11 filing could ultimately have? Presumably they're pushing back because they've got no other alternatives. There are no other people to fill the blank left by WeWork.
And what's interesting too, guys, if you look at the occupancy that WeWork was posting at the end of the summer, it was about 3/4 of the space was still filled. You could take that however you'd like to take it, but it also was a matter of a company with very significant liabilities here, and let's just say it, years and years of financial mismanagement.
Yeah.
And so had they not taken on all this debt, had they not negotiated these leases the way they did long term years ago, then would they be in this position today? I think that is up for debate.
Well, I mean, it reminded me when I was reading it on the way in of what we saw with SVB, right? You just have long-term liabilities and short-term, I'll call them deposits, but that's kind of what they are when you have your renting for a week or a day or a month or something. Isn't that just in essence what this is?
Yeah, that was one of the problems. And then they had the pandemic and they had all sorts of other issues. But, you know, later this week we will be talking to one of the rivals, for example, because we have seen some sorts of businesses like this go under or face serious pressure. But we have seen others starting to lean in because there are places that are trying to have more flexibility for their employees. And so are they going to come in and take advantage of this pressure on New York City and other large city real estate and come in and take these leases at lower prices?
Talking of pressure, how much pressure is Harvey Schwartz under right now?
That's my favorite question of the day, guy. And it's because you're seeing Carlyle really starting to take shape under Harvey Schwartz. I think one thing that is really a bellwether, not just for Carlyle, but for the entire industry, is you have Harvey's CFO saying that no expense is sacred. You are starting to see cost cutting now really take hold at the biggest private equity firms, particularly at Carlyle, which has its own challenges. But this idea of seeing cost cutting starting to take hold in the private equity industry at a time where we are seeing massive pressure on deal making is fascinating because we may start to see it at other places as well.
But if you have like an insurance arm like KKR, or you have other arms as well, or you have a robust private credit arm, maybe it's not so bad.
Absolutely, and you see KKR really being able to beat that trend in terms of really severe pressures on profit because they can't exit private equity investments because they have that insurance arm that is helping them. Remember, KKR and Apollo are really the only two large asset managers with a large insurance company on their balance sheet. And by having that insurance company, they're able to make spread when they take that insurance company assets and put it back into debt investments, real estate, what have you. And so Apollo and KKR are really showing up as the clear winners in the private asset industry today in this environment because of those spread-related businesses that they have under their wing.